The exit process in private equity starts when you invest. So from day one, your hypothesis and your investment case is built around what you're going to do with the asset. We refer to that as our value creation plan when we enter into the investment.
What we found the best results is I suppose, like going into a new asset, is the preparation side. So we like to target what we feel are specific likely buyers, interested buyers, or buyers that are going to place value on the business, and then sort of try and target them, and off the back of any interest that's generated, create a pool of buyers. But there's definitely, we've seen it where we've had people that have a compelling reason or rationale, you get a much better price, and that comes from doing a bit of research.
You can't count on luck, you can't count on timing, and therefore you've got to prepare as best you can for an exit process. And in our view, and our learning has been that you start with the exit process when you buy a business. I think lots of people will say to you that in assessment of a business, you always look at who would be the potential buyers for that company when you want to sell it. But I think it goes beyond that. I think when we buy those companies, we also make sure that we position our rights in terms of shareholders agreements with management teams and with consortium partners in such a way that we can give effect to an exit. So we've got to be able to realize a company at the back end, and we've got to make sure that there's complete alignment between all the consortium partners.
I think a key thing, and certainly one of the successes, or an element of the success of the process, is to get management's buy-in from the beginning. I think anything that seems to be coerced or hostile or whatever really undermines your process, and it's vital to get an appropriate price and a good sale process, to have management interacting positively and also attending to the potential buyer's queries.
Exiting a minority position is particularly difficult. Management always holds the keys in any exit process, but they have significantly more influence if they also hold the majority of the shares. But it is one of the pitfalls, unfortunately, of trying to exit minority positions. And I think particularly in growth companies, you'll most often find yourself in a minority position, and it does create issues around exit that you need to be aware of when you go into these kind of investments.
That's a key reason why we do take controlling stakes, is so that we can effect an exit. If you're a minority, sitting alongside a majority shareholder, you are to some extent at the mercy of the majority shareholder, depending who that majority shareholder is and depending on the way that they consult with the minority shareholders.
Keeping a tight rein on the process and therefore the timing of it is so important. These things have a habit of drawing or taking maybe longer than you think, and time is the enemy of that process.
The economic situation, either in a country, in the world, in a region, often dictates whether one should accelerate an exit program and sometimes take a quicker exit, or you need to make a call, and a measured call, whether you should hold a bit longer and wait for further growth or further stabilization in currencies going forward. And it remains a opportunistic point of time often, but still based on a plan that one drives quite vigorously.
I think all exits tend to develop as you go along, and they are influenced by how the business itself develops. They are influenced by potential partners or other companies that may approach you during the life of the investment.
I think it depends on the asset and the quality of the asset. I think that I've seen all the routes, starting from trade sale, financial buyers selling in a secondary, IPO, or selling back to management team. And all of those differ. I think clearly what you want to do is you want to make sure when you buy an asset that you can position yourself for disposal of the asset to the widest range of potential buyers. That is first prize. So run a competitive process, have an IPO backup as a possible route to listing, and that is the clear preference. But all assets don't work that way. Certain assets you've got to go and dispose in processes where You have to engage exclusively with one party because it makes sense for that asset to sell it in that way. Certain assets you have to go and dispose back to the management team because they're the logical buyers of an asset and you won't be able to have an effective auction process. And I think flexibility and really the art of determining which one would work for you, for your stakeholders and for the company, I think that is not straightforward and you've got to work on it and it takes quite a bit of time to get that right.
In this case, Surgical would have been too small for a listing on its own, so I don't think an IPO would have been possible. I think the likely exit options for Surgical always were intended as a trade buyer, as a priority, potentially a management buyout, or else to another financial investor. So I think in order to maximize our exit, a trade buyer would have been preferred, and we managed to attract Ascendis. There's not much that would have changed. We didn't have advisors really involved, and it was just a principle-to-principle discussion on a relatively short time frame. It wasn't dragged out, and we managed to execute it, I guess, in two months. On exit, we achieved on the equity portion a 3.5 times return on or times money, and about a 30% IRR. On a gross basis, we did 2.8 times money and 28% IRR.
I think certainly the private equity industry at this point is has a number of investments in portfolios that will need to be realised over the next couple of years. Market conditions have improved, I think, to the point where pricing is reasonably attractive for the owners of those businesses. I think it's well known that there are some big companies that are likely to list on the JSE that are owned by private equity firms at this point in time. There also continues to be quite a lot of secondary activity going on between private equity firms where they are buying assets from each other's portfolios. We have also seen some interest again from corporate buyers. So I do think that we're going to see an uptick in exit activity over the next 12 to 24 months.
I think the market is buoyant. I think there are lots of financial buyers. I think the IPO market is very attractive at this point in time. And I think trade buyers have got lots of cash, so they're interested in assets. And that's nice about trying to sell into the South African market.